Hey everyone, I want to thank everybody for taking a Friday afternoon, I guess it's right at noon, to join us today for our webinar. These are webinars that if you're a friend of somebody that's joining today, these are webinars that we typically do live as a food for thought where we talk about different topics. Obviously, there's a lot of stuff going on in the market today, so I thought that it would be great to do something a little bit different today. Most of you are used to seeing the advisors that you work with, and you've seen videos that I've done, but I thought I would introduce you to a couple of other gentlemen that work for our firm behind the scenes. And it's my pleasure to introduce to you Rob Emrich and Joshua Wilson, our CEO, both who are senior members of our investment committee. Today, we're going to talk about investing during a pandemic and how it has impacted the decisions that we've actually made on portfolios. Before I start bombarding both you, Joshua and Rob, with questions, I thought I just want to get a little bit of background on both of you and some personal information, if you don't mind sharing. Rob, you mind starting?
No, not at all. Thanks for having me on, and thanks everyone for being here. In a normal environment, I like to meet you face to face, but this will serve the purpose for today, and we hope we can get your questions answered. I grew up in Maryland, moved to Texas in 2004. I have a wife and a daughter who's 2.5. I have a son who's 17 years old. I've been in the investment business over 20 years now, and fortunately or unfortunately, this is my third economic crisis I've experienced in my career. During my career, I've developed trading strategies for the futures markets, including oil, natural gas, foreign currency, built derivative models, and for other investment firms as well, I've built portfolio models that are risk-based and goal-based for clients.
That's great. Joshua, how about you?
Yeah, Reid, I grew up on a farm in rural Alabama, middle of nowhere, and went to Brown University for my undergrad, Salve Regina University for my graduate degree, studied the Investment Banking Institute, as well as I'm a chartered market technician, which is really kind of saying I have some advanced training on charting and looking at data in very visual ways and that type of analysis. And I enjoy spending time with my family, enjoy being outside, play guitar, love to sing, and I'm a big sports, especially football fanatic. So my background in the industry started most of my career at TD Ameritrade, traveled the country teaching active trading options, technical analysis, and then also at previous firms I've led as a co-chief investment officer, as chief investment officer and a co-CEO my previous firms as well. Been in the industry about 15 years.
Oh, great. Well, thanks guys for sharing that information. I really appreciate it. First, thank you for submitting the questions. You guys watching this webinar today, I'll use the questions that you had sent in, and I might use your first name. And if you don't see your questions, some of the questions were kind of close or similar. So we use the first name of the people of the questions that we used from many of the people. So I also want to inform everyone that raising your hands today to ask questions has actually been taken down. This is probably the largest webinar we've done to date. We have over 300 people registered for today. So thank you so much. First and foremost, I believe this is going to be fun and engaging, and I'm super excited, guys, because today was the last day of school for my kids. It's Friday. We're going into Memorial Day weekend. I'm super excited. So, okay, so let's get started. Joshua, this question is going to be for you first. The world has never experienced a year like 2020. But before we talk about 2020, would you take a few steps back and talk about our philosophy, where we were a few months ago, and more importantly, the decisions we made back then?
Yes, Reid, I think going into 2019, it was an interesting time. I've never seen anything like it. People seem to be forgetting about the last financial crisis. You've got the Robinhood app, you've got robo-advisors, you've got discount brokers offering free trades. So it just seemed easy after a 10-year plus bull market. It seemed like everyone was an expert and everyone thought it was easy. So people were piling into the market. And Reid, during a time like that, we say, hey, when everybody's feeling greedy, that's when we kind of start feeling a little more fearful. So, last summer, we really started transitioning into a more conservative portfolio. Now, I think we were probably a little early on that, but that really gets to the core of our philosophy, Reid, which is really preparation beats reaction. So coming into the year 2020, we really felt like we had prepared for, hey, I liken this to driving a car down the highway. When I think of driving a portfolio, and we start looking at the cars around us, everybody's going faster and faster, and then I see storm clouds in the sky. All these factors start adding up, and no one seems to care. Everyone's just, hey, let's go faster, make more money. So at that time, we said, hey, let's be prepared for this. We really felt like there were storm clouds on the horizon. So we started preparing, adjusting our portfolios. And again, I think we were a little early, but I really believe that paid off for us big time in Q1 of 2020. We're never going to time things perfectly, but what we have to do as investors is get away from the binary thinking. In other words, am I all in or am I all out? And really start thinking about preparing for what's ahead. So when March hit with the big hit in the market, we weren't saying, oh, what now? How do we react? No, we felt prepared. And now we're thinking, okay, we were prepared for this. We feel good. What actions do we need to make now to prepare for the next 6 months, the next year, rather than reacting? So that preparation really was a great thing for our portfolio in 2020.
I love that you said that preparation beats reaction. I was talking to my son. He's actually on the golf course right now. So you golfers, you can be jealous of Ethan right now. He is he's trying to beat the rain for this weekend. But I've talked to him about the importance of preparation, and I think that's even more important on the portfolios that we manage and that your advisor and myself are helping you folks out with. So I appreciate you saying that. Rob, Joshua talked about that we felt prepared for a difficult market, and therefore we didn't have to react or panic. Talk to me about the result of that. What did that mean for portfolios in March? And more importantly, when the market is particularly volatile, why was that so good?
Yeah, I would say one word: diversification. And diversification works. And if you look at the portfolios that were constructed at Lake Point, they were very well diversified, both on a global basis and an asset basis. You had assets in the equity market. You had assets in the fixed income market, alternatives. In addition to that, these were global portfolios. And what does that all mean? Well, on March 24th, when the Dow was down over 30%, it looked like economic calamity. Our moderate to aggressive portfolios were down anywhere from about, low single digits to about 15, 16%. So that translates to about 50% downside protection on our most aggressive portfolios in the worst economic crisis we've seen since the Great Depression. So I would say diversification works, and we were prepared, and they behaved as expected.
I think that a lot of people can appreciate that, because we did have a lot of people saying, hey, are you guys magic? How did you navigate through that? So I think that diversification is the key word. Joshua, the markets are not quite back to where they were before, this pandemic. We had a lot of questions coming in on why we think the market bounced back so quickly from the lows.
Yeah, Reid, I find that the markets are long-term rational, but short-term irrational. And when you think about it, you're looking, I looked at charts during that time, and, Procter & Gamble, the company that manufactures Charmin toilet paper, got hammered. I couldn't find Charmin toilet paper to save my life. You're telling me that their business is down 40% with a stock? Absolutely not. That is absolutely an irrational reaction to what had happened, right? So what had happened is, the markets got very irrational. A lot of people got scared. They were not investing according to a plan. They didn't know why they owned the things they owned, or why they would hold on to those things and understand the risk they were in. So it was a massive run for the door. And then it's just supply and demand 101, basic economics. when everyone's trying to sell and no one's buying, everyone's waiting, that price just keeps going down irrationally. So, a few days in, a couple weeks later, it bounces back as more rational minds kind of take over. And now, so that bounce wasn't a surprise. But now we're starting to be thinking about that long term. So while I think that quick bounce was expected, now the rubber kind of meets the road, and where are we going long term? The second thing I'd say is we have to think of while we can think of, here's everything going wrong in the United States, it's easy for us to have that home bias. It's also important to remember the United States market on a relative basis. So compared to the rest of the world, we still have a lot of things going for us. And not only do we know that, but foreign investors know that as well. So there's an opportunity here as a safe haven economy for those dollars to flow here. And I fully expect dollars to flow into the United States dollar and United States investment from foreign investors.
Yeah, I like that you brought up that there's opportunity. That's something that, that a lot of people are calling and talking about. So I appreciate you bringing that up. We've had a lot of people jump on over the last 5 minutes. So I just wanted to make sure that you know who is talking today. We have, I'm usually the one doing these webinars, and I wanted to bring on a couple of our people that work behind the scenes. Rob Emrich and Joshua Wilson, both are on our investment committee. And Joshua, who you just heard from, is our CEO of Lake Point. So again, I just wanted to bring that up. Rob, we've had so many questions come in about market volatility. That is probably the one question that we hear a lot of. And Dorothy asks, when will we recover from this? Joyce asked, when is the turning point? When the turning point will come? Janie asks, when the market will stabilize? Ralph asks, will we be back to pre-COVID levels anytime soon? Ted asks, about minimizing loss. My kind of question to sum all of those up, Rob, was, the market has rallied off of its lows, but do we think that the rally is sustainable, or is volatility here to stay?
Well, that's the million-dollar question, right? We've certainly experienced a shock to the markets, as I mentioned earlier, at an unprecedented level. I mean, if you think about the volatility environment or the volatility regime we were in prior to this event, specifically last year, we had hundreds of days in the market where the market barely moved 1%. And now we've literally, just within the last 30 days, had multiple days where the market moved 5.5%. I mean, that type of volatility is unprecedented. Now, as far as when we're going to recover, I mean, there's a lot of unknowns out there. Are we going to get a second wave? Are we going to get a vaccine? Is the vaccine going to work? Will we have herd immunity at some point? We don't know the answers to these questions, and experts vary in their opinion from 1 year to 5 years. We don't know. We don't know the answer. While volatility, though, has come down recently, which is good, to answer your question, come off the lows. Could we retest those lows? Hopefully not, but we could. Our portfolios are prepared for that if we do. Volatility has settled down. We're seeing movements of about 1% now. We could see some volatility going forward. While volatility has come down recently, market sensitivity remains. Markets are very sensitive to headlines. One headline could throw the market in either direction. So the short answer is we don't know, but these portfolios are designed, they're like all-weather tires. They are designed for the worst type of climate we could enter into, and they're designed for the best environment we can enter into. So we're prepared for it.
Yeah, I like hearing all-weather tires because this is unprecedented times. So that's a great analogy on that. Thanks for sharing that. Joshua, we've had many questions about taking advantage of this downturn. And I know that recently we increased our allocation to gold, and nobody is a bigger proponent of gold than you are. Tell us why you're so convinced on this.
Well, Reid, I'll qualify that with saying, I'm not always a gold bug, but I have definitely jumped on that bandwagon with quite a bit of enthusiasm here of late, and really that started mostly last year, more Q4 of 18. We really started looking at the gold, and then last summer became a big thing for us. But gold is a very special asset class. Strictly speaking, gold is a commodity, like silver or like soybeans, it's that sort of thing. but it's very special and it's also like a currency. It's a global currency though, and it's not tied to just one currency. And in the past, we've seen it behave as a safe haven investment. Latin American debt crisis in the 80s, Japanese stock market bubbles in the 90s, Asian crisis in the late 90s, dot-com bubble burst in 2000, Lehman bankruptcy in 08. Global fear really is kind of good for gold. It is a safe haven. So, when I say safe haven, it's something that, and this is why I say I'm not always on the gold bandwagon. Gold doesn't produce any income. It doesn't pay a dividend. It doesn't sell anything. But what gold is again, a safe haven. In normal times, it's a drag on a portfolio. So don't be surprised that we didn't have gold in the portfolio in 2017, 18, right? It can be a drag during certain economic conditions. But during a time like this, we believe it's great, especially, I get so many questions about the Fed printing money. I think they're probably raising that 20% or more a year right now. Listen, the production of gold is going up only about 1% a year. So if you think of gold, the more gold behaves as a currency, the more bullish I become on gold.
Great. What about silver?
Silver's a little different. Silver is mainly an industrial metal. It can be a monetary instrument. So I look at where is demand coming from. When interest rates get to that point where real rates start dropping below 1%, then it's more likely that silver becomes more of a currency versus a commodity. The thing with gold, it's very with silver, it's very bulky, very heavy. So people have to pay to store silver. So it really interest rates have to really get down there and to the point of negative interest rates to really be a store of value. So I'm not bullish on silver when it comes as an industrial metal right now. But if we get to the point where we're really pushing into the negative interest rates, again, I hope that doesn't happen. But if it does, silver could definitely be on our radar pretty quickly. So silver is something we're watching, Reid.
Great. Thanks for sharing that. Rob, This question comes from Russell. Are you planning on doing anything with real estate, and why now?
The answer is yes. And why now? To answer more specifically, real estate, as we know, you mentioned your son's, on the golf course now, the economy's starting to slowly reopen. My son waits tables at a restaurant, and that restaurant's operating at about 25% capacity. So when you talk to people about real estate, they think of the worst case scenario, the worst case that we've experienced in the last 30 days. Business going bankrupt or can't pay their leases. But that's a small part of real estate. And I can tell you, yes, we were moving into real estate. We made the move after the sell-off occurred. So real estate was down about 32% when we moved into real estate. And the way we moved into real estate was through a vehicle called the Dow Jones Global Real Estate Index. So it's an index, and this index comprises of residential real estate. There's industrial real estate in there. There's healthcare companies in there. There is some exposure to small retail, but there's also self-storage companies in there. So it's a very well diversified portfolio. And we feel strategically long-term, real estate tends to have a lower correlation with stocks and bonds. And we think strategically now, long-term, it's a good place to be. We have a modest allocation. It's about 5%. But listen, we believe our economy is very resilient. Americans are very resilient. I just saw the other day where some restaurants to increase their capacity, states or municipalities are allowing them to put tables out in parking lots and on sidewalks. We will get through this. And while it doesn't feel good to invest, to buy something that's low or beaten up, sometimes we look back at this moment 2, 3, 4 years from now, I think we'll say, wow, what a great investment, what a great choice that was.
Yeah, I think it goes back to what we were talking about earlier, is those opportunities sometimes arise. And so I think that's part of the reason why the investment committee shared that that's what they were going to do. So that's great. Joshua, compared to last year, would you say that we're positioned more conservatively, more aggressively, or about the same?
As I mentioned before, we really started kind of shifting more conservatively last summer. So, but even since then, we were a bit more conservative. So quite a bit more than early last year. Since mid last year, we're a bit more conservative overall across the portfolios.
Speaking of risk, we've had a lot of questions on investing in oil recently. And I remember you asking about oil earlier this year, and you told me there's too many ifs. And so share with me what you meant by that.
Yeah, so Reid, when we're looking at a potential place to put money, I tend to classify things as investments versus speculations. Investments are things that I can really understand well. I can understand what goes into them, why they would be successful, the things that would get in their way, and I can calculate the probabilities of these opportunities and risks. I think of those types of things as investments. When it came with oil, there became a lot of coin flips. And it's, if Saudi Arabia does this, then boom. If Saudi Arabia does that, then boom. If Russia does this, this happens. If futures contracts happen with this and they roll with this, all these complicated contracts, it was a lot of coin flips, Reid. And so I don't make investments based on coin flips, on if this, if that. I can't calculate that. If I can't calculate that market, then to me that's a speculation, it's guesswork. So we said, hey, you know what, we're gonna stay away from something that we can't calculate. And I remember having that conversation with you, with a couple of those ifs. Reid, I could explain to you why this could be a great time for oil, and I can tell you about why this could get crushed, and it's a coin flip. And you know what we saw? We saw the crushed coin flip. So I'm happy we took those steps. And you know what? The thing is, Reid, we could have been wrong. A few other coin flips could have went the other direction, and oil could have taken off in the other direction. But still, it's prudent to understand that was a very speculative time to invest in oil. While it worked out this time and we avoided it, I'd make the decision again, for sure.
Yeah, I think that a lot of people can appreciate that for the fact that we're investing money that most people are going to either need for retirement income or for passing on to beneficiaries, and that they have very specific goals. So I think that they appreciate that we're not being speculative on things that, have, boom, it can do this, boom, it can do that. That was a great analogy of that. Thanks. Rob, this question actually comes from John. With the Fed printing money, it seems like an infinite amounts of money for the COVID-19 crisis-related bailouts. What do you think about will happen to interest rates and then tax rates?
Don, that's the question that a lot of us are asking right now. We've seen an interest rate environment where the 10-year Treasury was 1.7, 1.6. We did an allocation to some bonds, and people said, I had one investor say, you're crazy. Bonds are at lows. Rates are going to go up. We said, we don't know where rates are going to go. So we have to have those assets in the portfolio. And subsequently, the assets did very well because rates have come down. And the reality is, even though the Fed is printing money, there's another component to the economic system. The economic system is very complex. It's a complex system. And we have one component. It's difficult to predict what's going to happen in the other areas. In this instance, while the Fed is printing money, people aren't spending it fast. They're not spending it. It's not cycling through the economy. So that's created a little bit of a drag and offset some of the stimulus that the Fed has done. So what does that mean for us? Well, it means that rates are probably going to be low. We're prepared for that. We have fixed income exposure. We have active managers in there that can make adjustments on the fly if they need to. And we think that, maybe in the next 1, 2, 3 years, I'd love to see rates go up. I'd like to see a little inflation, quite frankly. I just don't think we're going to see it.
Joshua, I want to kind of keep on that same topic. Speaking of interest rates, here's a question from Paige. Paige was asking, things seem pretty tight right now with bonds. How are we addressing the fixed income situation in our families that we work with portfolios?
Yeah, that's pretty important. So while we've kind of talked about some of the negatives of the Fed's actions and how that impacts us, understand the Fed's actions affect different markets and different investments differently. Okay, so while we say, oh, that creates a risk over here, we got to be careful about this, also creates opportunities. the federal government on many levels has come behind and said, we are going to support the fixed income market. We are going to increase our balance sheet. We're going to own bonds. We're going to own different kinds of bonds. We may even buy stocks. I've never seen that in my entire career. And as you know, Reid, I'm a student of the history of the market. I can tell you it's never happened before, right? The amount of the support the government's willing to put behind these markets. So we say that, we say, okay, listen, this is not a time to be, and we talk about, there's always this active versus passive debate. We're not committed to either one of those. We believe there's times and situations where active has a better chance of providing value than passive. In a market like this, we've decided to push more of our fixed income investments into active manager investments rather than just owning the market. We believe there's a chance for these active managers to be specific, to understand what's happening, which sectors, who's getting the benefit from the government, which companies are benefiting from this, because, hey, the government picks winners and losers. So during a time like this, we believe that active managers have a chance to make some strides. So this bottom line answer is we've transitioned more of our passive fixed income investments to more active and selective.
I like that you brought that point up because, there's these, you kind of brought up robo-advisors and you brought up, this kind of cheap investments, but there's also cheap type of investments, right? There's nothing being managed. And it's just like, hey, buy, hold, and hope. And so I really like that you brought up that we're not tied to anything. There's places for each type of that management versus being on one side of the coin or other. That's great. Rob, this question comes from Laura. Should I move to cash or ride out the rest of the storm? Or, would that be a mistake to go to cash?
We are getting that question a lot. And this isn't the first time I've had that question. I had it in 2000, 2001, had it in 2008. In fact, I know of an investor in 2008, if you can imagine this, in March of 2009, decided, I'm going to go to cash. I want to wait till things feel better. Because guess what? When you go to cash, temporarily, that will feel good. You may sleep a little better at night, temporarily. It'll feel good until it doesn't. The investor that I was speaking of in 2009 never felt comfortable re-entering the market. And guess what? The market's up over 300% since then. Think about that. If you have $1 million, you needed to grow to several $1 million for your retirement and just sat in cash. Personally, I think that's riskier. I think going to cash is riskier in the long term than being invested in the market. So I would say, if you think back to the previous question about volatility, we are in a market where we could see 5 to 6% swings in a day. I can tell you there's probably nothing in the next year or two that's going to make you feel good about investing. And when it does feel good to invest, you're probably going to miss, you could miss 10, 15, or 20% of the run up. And then what happens is you say, well, I'm going to wait for the next pullback. And then it doesn't, it just keeps going and going and going. And you can never play catch up. Let us manage the money. You're in good hands. We do a good job. Joshua mentioned, a Robinhood app. Well, Robinhood got all this press. They raised all this money when they launched. They signed up all these people. And guess what? When the market collapsed on March 24th, Robinhood people, their whole system shut down, and it's shut down twice since then. So sometimes going to something that's cheap or free can be very expensive. I digress a little bit, but I wanted to mention that point. Stay invested, resist urge to go to cash, as long as you have a long-term time horizon. History shows us you should be okay.
So I would add to that we just got through talking about the Fed printing money. What does that mean? Well, we just talked about supply and demand. So what happens when there's more and more and more and more supply of something? Well, the more supply of something is, the less value that it has. Okay, so if you're holding dollars, it's like being invested in dollars, knowing that more dollars are being printed, right? So it doesn't have a chance to grow. So what you're doing is you're committing money to an asset that if the Fed is increasing the money supply by 20% a year, what does that tell you about the value of your dollar? So it's not just getting out of one thing. When you get out of one risk, you accept another risk. That's important to remember.
That's a great point. I think the other point to remember is that I don't think anybody's found that magic crystal ball. So if somebody had it, we're all going to follow it. So making sure that, we stick to a plan, I think is absolutely prudent. I think that's kind of what Rob was alluding to. So that's great.
Yeah.
Joshua, what would you say your number one most important mistake to avoid is?
Whew, that's narrowing it down to one. There's so many potholes that we can crash into. Reid, I think a lot of people probably expect me to say something investment-wise and specific to the market, but what I've seen time and time again is a failure to plan. Because without a plan, people tend to be very, very emotionally reactive. And I just said before that, that reaction is the enemy. We want to be prepared. I'll give you a story. At the very beginning of this crisis, I had gone to Alabama, where most of my family is located, and my mom and I were sitting at my sister's house, and out of nowhere, this is Alabama, a lot of tornadoes, all of a sudden, tornado warning. And my mom's initial reaction was, tornado's coming, warning, I'm gonna jump in the car, maybe I can make it back to my house before the tornado hits. So her instinct was run for the door. I don't know what's going to happen. Wasn't prepared for this. I'm going to run for the door. Just get out of here. Okay. Well, my first reaction was, wait, I don't want to be in the car. I'm going to sit here. I'm safer to just sit here and wait this out. Okay. So my instinct was freeze. I'm just going to sit here on the couch. We're fine. I'm not going to get in the car. Mom, don't get in the car and run away. Just stay here. Okay. But both of those were kind of extreme reactions. Stay put, don't move, versus run for the door, try to outrun it. My sister said, hey, guys, I have a storm cellar. I already have a plan. You guys join my plan and come to the storm cellar. So what I would tell people right now is avoid following the gut reaction of my mom, which is run for the door, and avoid my gut reaction. As again, I wasn't prepared. I wasn't prepared, so I'm just going to stay put and see what happens. Hopefully I'm not blown away. No, even in the middle of the storm, take some time, get a plan, adjust your portfolio, make sure you're properly prepared for what's next. Don't run for the door and don't just stay put. Make sure that you're getting a plan even in the middle of the storm.
Yeah, and I would say that that's the job of myself and the other advisors that you work with, is making sure that you have that plan. I also say that there's another component to that where I'm a financial counselor, where people, you mentioned making irrational reactions, and I think that that's an important piece to bring up. So I'm really glad that you said that. Rob, Kevin asks if you're exploring other investment avenues other than investments that are tied directly to the stock market. How about endowment funds?
When we get questions about, what other assets should we invest in, I would just say this, just broadly speaking, we like investments that are what we would call liquid. And what does that mean? What is liquidity? Liquidity means that if I buy something, can I buy it now at a good price? Because there's an active market for it. There's a price discovery mechanism. And conversely, if I want to sell something, is there a market to sell? Are there buyers out there? And there are a lot of illiquid investments out there. And I've learned a long time ago that when you can't get out of something because there's not a price discovery vehicle, or you don't know the price of something, the price drops and you're stuck in it. So because of my previous experience, it's taught me to look for investments that if you want to get out of something, you can get out right now. So we value liquidity. I mean, liquidity in some instances could equal safety or imply safety. And that's very, very true. Now, moving over to the question about endowments, endowments are private, call them accounts that are run by charitable institutions that have, typically timeframes into perpetuity, meaning the money has to last forever to meet some obligation that they have. And so they'll invest in timber and they'll invest in those sorts of things. They can afford to have some illiquidity in there, but those investments into endowment funds are not open to us. And I'm not sure that I would invest in them if we could, but those investments are closed investments or private investments specific to each institution that has those.
Yeah, and I think that you kind of hit the nail on the head there, is that each individual person, family that is watching this today is completely different. Their income needs are different. Their goals and wishes are different. And so being illiquid probably could be dangerous for a lot of those goals. So that's a great point to bring up. Joshua, Ruth, we've had a lot of people talking about this. Interest rates are essentially zero right now. And Ruth, writes in that she has a CD that's coming due next month in June. She wanted to know how she should re-enter the market, or if she should.
Well, Ruth, this is one of those things that's really specific to your situation. Frankly, I don't know enough about you to speak intelligently to this. Maybe you shouldn't invest in the market. Maybe it's not the stock market that you should be putting your money into. Maybe it's a different type of solution, different type of product. I don't really know how much risk you want to take, or what is this money earmarked for? Does it need to produce income for you? Do you need it in the next couple of years? So I'm not really sure if you should put it in the market at all. Maybe it should go back into a CD. Maybe it should be looking at a different type of a product or solution. So this is something that, speaking to one of our advisors, would really be probably more productive than a group call like this. They can ask you those specific questions, understand your risk, and then give you your options and make sure that you understand them.
That's great. That's a great point. I think that everybody has a different situation. The radio show Well Smart that I did for many years, I always said we should have named it. It depends. It depends on your situation. It depends on what's going on. There's so many different variables that you need to consider. I'm glad you brought that point up. Joshua, this one's back to you as well. Colleen writes in and says that her husband plans on retiring in about the next 18 months or so, and they don't have time to wait this out. She asks, what now?
So this kind of reminds me of my story from a few minutes ago. Is do I just sit here and wait, or what do I do? So what now? You can't wait. You can't just sit on the couch and wait for this to happen. This is, again, kind of probably time to sit down with an advisor and understand your entire situation. I'd want to understand what assets you have currently and how they're invested. Are you properly insured? What if something happens before the retirement even happens? So I say definitely don't wait it out. Sit down, understand where you need to be in a year, what those things are that step in between you. Ultimately, it's going to come down to this. You're going to need to have an emergency fund. Number one, make sure you have enough emergency fund if something was to happen. An advisor can help you determine how much that should be. You need to get your Social Security planned out. I don't want you just doing what your friend said to do because they took it earlier, they waited. Don't do what your friend said. Talk to an advisor. Let's make sure you have a plan for taking Social Security. That's number two. And then number three, of course, is reviewing those retirement objectives and making sure that the amount of risk that you're taking is lined up with where you need to be. So emergency fund, Social Security plan, and then lining up your portfolio with your plan.
Yeah, I think that most people are just focused on how much money they save, and they don't realize how important the filing for Social Security is. There are literally hundreds of ways to do it. And then more importantly, if you've already filed for it, you need to understand how to reduce the taxes on that, and the implications of that. So that's a good point. Joshua, also back to you. Ursula writes that she's close to retirement right now, and she asks, what's the best course of action would be for financial stability?
I think that's, maybe I probably could have pushed forward a little bit, but it kind of comes down to what I said before with the number one, emergency fund, making sure that's well, because here's the thing. It doesn't matter what your investments are doing. If a life catastrophic event happens and you have to liquidate everything at a bad time to pay for that, then it didn't matter what the investments that you selected, right? All of a sudden you have a medical bill or something like that. So that emergency fund, and plus insurance. And you know what? Insurance has never been fun for me to talk about. Reid, you know so much about insurance. You have such a great depth of knowledge there. It's hard for me to wrap my head around it. I come to you in my insurance questions. I love the markets, but that is something that, you've taught me that it has to be a part of the conversation, Joshua. It's absolutely necessary. So emergency fund, insurance, and then the Social Security plan, and then of course, reviewing those retirement objectives.
Great. Rob, several have noticed, so going back to kind of the portfolio and how the makeup looks right now, people have asked or noticed that there's more cash in their accounts right now than they're used to seeing. Why is this?
Sure. We would normally have about 2% cash in the portfolio. Now we have about 4%. And there's really two reasons for that. both of them will result in the same outcome. We think that we need some dry powder in an environment like this. An opportunity is going to present itself in the form of either rebalancing, adding money to an asset class that gets beaten down further, or increasing the target amount to one of the assets we've already selected. So really, it's opportunistic, allows a little bit of flexibility, and gives us dry powder. But we should see, I mean, that 4% threshold, you'll probably see it drop down to 2%. If I had to guess, it could be anywhere from 3 to 9 months.
So what I hear, you got some research going on, and you kind of have some direction on where you think you're going to go. But anything can change. I mean, this has been completely different for sure.
Exactly right.
Joshua, a lot of questions have come in, mentioning the virus. As the CEO of Lake Point Advisory Group, you've got to think not just about the portfolios, but the health and safety of the employees and our clients who, as we reopen, come back into the office. Talk to us about that.
Yeah, so the staying healthy is kind of number one. It's kind of a prerequisite for everything that we do here. So, Reid, we went to remote work pretty early. We had prepared for that over a couple of weeks to make sure that our employees would be able to function in their jobs from their homes, making sure they had their phones, their computers, they had connections, all that sort of thing. And so we've really, one of the great things about what we do is we can do everything we do without ever actually sitting face to face with the client. So we went to that early, and then since then we've been social distancing. But now we're talking about coming back to the office. But we've put a few things in place. We're marking off some social distancing. We are relocating some employees so they won't be sitting in such close proximity in our offices to other employees. We're adding sanitation stations throughout the offices. As you come in the door, we're about to have one in Rockwall. We're adding more frequent deep cleanings of the office, so we're making sure that we continue to just keep those spaces. Also giving our employees access to their own cleaning supplies, and so they can really kind of own their own spaces. We've given clients the ability throughout all of this to meet with us via webinar and phone. That's still the safest course of action. It's still the course that I recommend is meeting with us via webinar right now. But we did open the offices beginning of this month by appointment only with advisors. So if you want to come into the office, you can by appointment only. Beginning of this week, we opened our offices optionally to our employees so they can start coming back. I believe we're going to open the offices back up officially June 1st, Reid. I haven't completely made my mind up on that, but we're making preparations for that that I just talked to you about with the continued social distancing and hygiene standards.
Perfect. Well, thanks, gentlemen. I really appreciate the time today. I've really enjoyed doing this. It's usually me on here, and it's better to talk with other live people. So thank you. Before we wrap up, I want to acknowledge you folks that took the time to actually write questions in and giving us some content to go over with some of the concerns and what we see from the investment committee standpoint. That being said, I want to encourage you, if we did not answer a question that you might have wrote in, please get with your advisor. They're actually listening here today as well, so that they'll know what we were talking about. More importantly, answer maybe some of those questions that you didn't have. Also, we had some guests that I really want to thank you for having joined this as well. If you don't currently work with an advisor right now and you want to have an appointment, feel free to give us a call. Our number is 214-771-3363. Or you can go even easier, go to lakepointadvisorygroup.com, and there will be an appointment where it says schedule an appointment, and somebody will contact you and get that scheduled. One of the things I like to point out is what Joshua said, is you don't even have to break social distancing to speak with us. We actually have live meetings on Zoom that we can meet with. Lastly, if you know of somebody that could possibly, use this information, or you think of someone that maybe might want to see this, we're recording the session, which is part of the reason why we didn't have you guys on this today, but we're going to be able to send this over to you so that you can watch the session live. I want to thank you so much for your time today. And if there's any questions, don't hesitate to reach out to myself, Rob, Joshua, or any of your advisors. And I hope you have a fantastic Memorial Day weekend. Thank you guys so much for attending. Have a great day. Thanks.
Thank you.
Bye, everyone.